in recent weeks. The rotation into value, how sustainable is it, and what has that meant in terms of greatest opportunities for the funds you oversee?
Yeah, well, thanks for having me. As far as valuations, they're higher than normal today. But the dispersions between valuations in the stocks are also still well above normal. Now, late last year, we hit 3-4 standard deviations above normal in market dispersions. Today, that's more like 1 to 2 standard deviations above normal, which is still very significant. And you know, the market doesn't always just go back to normal. It sometimes overshoots the other way. So we're still finding very attractive opportunities in a somewhat expensive market.
In terms of this debate around Treasury yields and where we go from here, and I realize they're under pressure today, do you expect those to continue to rise? And I guess whether you do or whether you don't, how does that play out within equities given the shakeout we've seen more broadly?
Yeah, at Oakmark, we're bottoms-up fundamental investors. We do not make macro forecasts. We take a more passive view on what the market gives us as far as interest rates. And it's our belief that at some point in the future, the bond market will very likely offer a positive real return. When that is really anybody's guess. I certainly don't have an intelligent view on that.
Yeah, I'm just looking at the performance of some of these funds in the fourth quarter as well. When I see a name like Airbnb that is in the Oakmark Select Fund, I wonder how you are thinking about the possibility of some of these new companies that are coming to the public markets and whether there's opportunities there.
Well, Airbnb was in the fund for minutes, not years, which is typical for Oakmark. And, you know, we believe we owe it to our investors to look at everything. We looked at Airbnb. It's run by great people. It has a great franchise. And the IPO price was well below our estimate of intrinsic value. So it went through our process as a value investor. We determined it met all of our criteria for investment. So we put in for a position. Unfortunately, we were given a trivial allocation. And then the stock price sold at our expected value within minutes of opening in the market. And so we sold it just as a discipline.
Yeah. International versus domestic this year, and I realize that for you it's not either or, but when you do see that the U.S. could, on the heels of more stimulus in the process of being passed and signed into law right now, could lead the world in terms of economic growth this year, how is that shaping, and I realize you're bottoms up, but how is that shaping your investment thesis this year?
Well, again, we're focused on bottoms-up valuations. Valuations in Europe are statistically lower than they are in the U.S., but Europe should be worth less than the U.S. market, given the nature of the growth profile. But we would say that the valuations in Europe are slightly lower than in the U.S. That's reflected in the global portfolios we manage, where we do have an overweight in European stocks today.
Are there specific names that you really like right now at these levels?
Yeah, I'll give you a couple examples of names that we bought over the last couple of quarters or two. The first one is Keurig Dr. Pepper. It's about 50-50 coffee and carbonated soft drinks. And, you know, it's got an above-average growth profile, above-average returns relative to its CPG peers, and yet it trades at a 15-20% discount to them and a 35-40% discount to where private market transactions occur in that industry. Now, why is that? There's two reasons. Number one is more technical in nature. There is a overhang on the stock, you will see, from the original holders of Keurig, who own around 50% of the company. And I think short-term investors are worried about them selling more of their stake and what that may mean and pressure the stock price. At Oakmark, our time horizon spans years, not quarters, and so we're not worried about that. We're worried about intrinsic value. Strangely, it's an odd positive in that now that they've sold their stake down below 50%, Keurig Dr. Pepper is probably the largest U.S. company that qualifies for addition to the S&P 500 that's not in it yet, which is fairly interesting. The second reason it's undervalued is I think the coffee business is misunderstood, in particular the growth rate of the coffee business. If you look in the rearview mirror, it looks like a low single-digit grower, because when it was private, the management team made the smart decision to reprice the pods, the single-serve pods, to make them more competitive with a pot of coffee or a cup of Starbucks. And that was the right move to drive penetration. And penetration in the U.S. is only 20%. Europe, it's over 50%. So we see a lot of runway there. But if you look in the rearview mirror, that pricing on those multi-year contracts for those pods with the Starbucks of the world has depressed the growth rate. That pricing pig is just about through the python here, and we think that the growth rate in the coffee business is going to accelerate, and that will force a closure of the gap between Keurig Dr. Pepper and its peers in private market values.
Shepard Smith here. Thanks for watching CNBC on YouTube.